and welcome to Season 3 of Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. I'm excited to kick off Season 3 with Vizo Financial's SVP Chief Treasury Officer, Tim Sustak, and SVP Chief Investment Officer, Scott Wood. Welcome back, Tim and Scott. Let's jump in. So, Tim, next week is the first FOMC meeting of 2024. Do you expect the Fed to hold rates?
Absolutely. Be completely shocked if the Fed did anything with rates next week. So there's just nothing out there to me that's, indicating that the Fed would move at all. Certainly not, drop rates, which is, I know, what the markets want to see happen as early as March. That's backed off a little bit. But yeah, consumer spending came in strong in December, was revised up in November. CPI came out a little bit hotter than what was expected. The job market stays solid. There's just nothing there that would push the Fed, I don't think, one way or another at this point. They are in holding mode. They're waiting to see that inflation will continue to come down gradually to their 2% goal. And when you listen to the Fed speak out there, like I said, that the markets are very strongly at the end of the year hoping for a March cut or predicting a March cut. I think the Fed's done all they can to kind of temper that. I don't think anybody's talked any other way, but look, most likely, we're looking farther into the summer for that. I think Raphael Bostic came out and mentioned third quarter recently. So, yeah, I think the Fed's definitely on hold. My opinion is they're on hold longer than what the market still currently thinks. But we shall see. That as always, they're data dependent, so they're going to react to what's going on. But it's going to take more than a reading or two for any particular index for them to make sure that they want to move.
All right. Well, I'm going to jump ahead then to one of my questions because, Scott, to Tim's point, the last time we met, there were thoughts of a potential rate cut in that first quarter. I'm thinking, based on what Tim, that might be off the table. What are your thoughts? And if so, when do you think that might occur?
Yes. So last year and really up until about 2 or 3 weeks ago, the market still thought we were going to see a rate cut in the first quarter. Nobody in the Fed gave any indication that they were going to cut rates in the first quarter. In December, they gave us their projections. They do every other meeting for where Fed funds would be. And what they do is they publish it in the form of a dots plot, and they show it as of the end of the year, effectively. So what the Fed has said is they're going to cut rates. They anticipate cutting rates 75 basis points this year, but sometime before the end of the year. They don't give any time frame on when that might be. But the markets, we have Fed funds that Tim alluded to there that tell us kind of the market's point of view of where rates are going to go. And they put money in the markets and they make these bets. They hedge positions and everything with Fed fund futures. And this kind of gives us an indication of what the markets think and where they think rates are going. And through this entire tightening cycle for the last year and a half, the markets have been well ahead of the Fed. And really disconnected from the Fed. They've been thinking the Fed's going to be not going as high as they went, and then they thought they would start cutting sooner. And of course, they haven't started cutting yet. But the market still thought the Fed that we would see a rate cut at the March meeting. Well, when I look today, finally some reality I think has hit the markets. Tim alluded to the Atlanta Fed President Bostic and his comments that he thought the Fed might cut in the third quarter is when they might start. And there's been some other Fed presidents and Fed voting members that have said something similar here in the last few days or last week or so. So when you look at the March Fed fund futures right now, they're giving less than a 50% chance of a March rate increase. As Tim said, really no shot for January. There's nothing out there that would indicate the Fed needs to cut rates. The markets now are saying probably not going to happen in March either. There's a meeting on May the 1st, and that meeting they're giving a little over 100% odds of a 25 basis point rate cut, the markets are. And honestly, if you listen to the Fed, that could be even a little too aggressive. And we'll talk about this, I think, later in the podcast about economic data and the things that, could force the Fed to start making cuts. But right now, it looks like the first quarter is probably not very likely at all for the Fed to cut. We could see something in the second quarter according to the markets, but according to the Fed, third quarter or later is probably when it would start.
All right. So Scott, what economic indicators should our credit unions be looking at from now until the next FOMC meeting in March?
Yeah, that's a good question. So there's so much economic data that comes out on a daily basis. I mean, it's crazy. All the data that's out there, and it'd be easy to really get lost in amongst all of that. And what the Fed looks at one point in time is going to vary. So depending on where we're at in the cycle and what kind of is the hot issue out there right now. So as we all know, this past year and a half or two, it's really been all about inflation. That's the whole reason the Fed started raising rates in the first place, is because inflation got really high. And they wanted to, they have this 2% inflation target, but they wanted to get inflation back down to that 2% level. So that, what I would say is one of the key indicators is going to be any of the inflation indicators. So we have three main ones: the consumer price index, the producer price index, and then the PCE deflator. The Fed likes the PCE deflator. That's kind of their preferred gauge, the core reading of the PCE deflator. The markets like that one. The markets tend to put a lot of weight to the CPI, which is the consumer price index. And then the PPI is the producer price index. That's the price that producers pay for, kind of raw materials that go in, the inputs basically, that in most cases that they're going to use to make final products with. So I mentioned this, but the consumer price index was a little bit hotter than expected this last reading, which would have been for December. It came out in January. That was a little bit higher than expected. The overall annual reading was 3.4%. They expected 3.2%. So it was an increase from 3.1%. And then when you take out the food and fuel prices, the core reading was 3.9%. So you can see we're still a good bit above that, the Fed's 2% target. And I was kind of thinking about this when I was watching football yesterday, the playoffs. One of the things in football and pro football, you notice a lot where teams drive down the field. They make a lot of really good progress. They might have a really deep pass. And anyway, it seems like they can eat up 30, 40, 50 yards quickly with the right plays. But then they get into that red zone, 20 yards out from scoring. And then a lot of times you see the other team's defense kind of, get a little bit tougher and slow things down a little bit. And that's what I would equate this, where we're at with this inflation thing right now. So the Fed is down to the 20-yard line. They made pretty good progress over the last year in getting us down really from the peak of almost 9%, over 9% really on CPI. And we're down to this 4%. We went below 4% on CPI, but now it's a little bit tougher, right? The defense is a shorter field. The defense has gotten a little bit tighter. There's other issues out there to deal with for the Fed. So this last little bit's going to be a bit of a challenge. They're showing it's going to be a bit of a challenge. And a lot of the experts think that. The Fed thought that themselves, that, hey, the last little bit is going to be more challenging for us to get there. And that's why they were pausing with a bias one way or the other. Now the bias with the pause is to cutting rates. But unless there's something really major out there pushing them to cut rates, there's no reason for them to start cutting rates just for no reason. They would cut them if they think the economy is going to start slowing. So look at CPI, look at PPI, less important than CPI though, because really the manufacturers, they may or may not pass on any savings that they achieve to the consumer. And really we haven't seen a whole lot of prices being cut. So maybe in the auto market, new autos, but CPI and PCE are ones that I would keep an eye on for the inflation side of things. Also keep an eye on retail sales to see how consumers, are they still spending money? That's a big component of GDP every quarter. So you can look at GDP also, but retail sales is an important indicator of the strength of the consumer. We've heard reports that some of that spending has been on credit cards recently, and we see that with balances increasing. But that's one other area to keep an eye on. And then another big one is just the employment numbers. If you start seeing mass layoffs by companies, initial jobless claims, they come out every Thursday. Keep an eye on those. Thursday morning, 8:30, and then the first Friday of each month, we get the official government's employment report. So that gives us the number of new jobs that were added or lost, as well as what the unemployment rate is. So that indicator is another important one. So those are the handful of ones that bear keeping an eye on.
Okay. All right. Thank you. So Tim, in the last podcast, we talked a little bit about the Bank Term Funding Program, but there really wasn't an update at that time. But I believe that may have changed. Would you mind sharing some information on this?
Yeah, sure. We certainly did get an indication there. Michael Barr, Fed's vice chair for supervision an event he was at in DC, came out and basically indicated that program would be ending at its March 11th, 24 1 year date. I think, bottom line on it, I think are two things. Number one is, it did what it was intended to do. And this is, what he indicated. It was meant to deal with the crisis that came out of the banking stress in the first quarter due to, asset valuations. We saw a number of banks in trouble there, and they came out with this program to really aid that and make sure that banks get a hold, credit unions could get a hold of, funds that they needed to satisfy any withdrawals from their depositors in the easiest way possible. And the program was definitely a success that way. Yeah, there is with the backup in rates. It's become a good ARB opportunity, meaning you can borrow substantially less at the Bank Term Funding Program than what you can invest at just putting the money at the Fed. So at this point, I think the Fed believes that mission accomplished, and it's time to move on from that particular program. So I think the thing, for credit unions to keep in mind is, we're not at March 11th yet. So still some time left. If you needed to use that program for liquidity, it's still not too late to get in. If you're in the program and you're using it for liquidity and it's, something you think you're going to need going forward, on the last day of the program up till March 11th, you can still borrow out to a year in that program. And of course, as always, you could pay it off with any time you would want without penalty. But, March 11th looks like it will be the drop dead date. So if you need that liquidity, make sure you're keeping an eye on that. Either get in, use it, or, refinance your loan. Make sure you have the liquidity as long as needed out to 1 year.
All right. Thank you. So Scott, it's been noted by many economists that one of the factors that has really given the economic strength is the unexpected strong jobs market. What can you tell us about the current job landscape and where it's headed?
Yeah, so where it's headed might be a little tricky. And part of this has been the job market has been really strong. It's held up very well over the Fed tightening cycle. But when the Fed started the cycle, I think we mentioned this on one of the prior podcasts, but the Fed thought we would start to see an unemployment rate of north of 4%. That 4.2 to 4.5% is where they thought we would end up once they were done with their tightening cycle. So the latest indicator is 3.7% is where we're at. So it's still very, very strong. Before the economic crisis and before this pandemic and everything, we used to think that the natural unemployment rate, just normal unemployment rate, was in that 4.5 to 5.5% range. And then you've seen over time here over the last decade or so that we've had long periods where we've been well below that. So that kind of number has changed, but we're still very strong right now. The Fed still thinks that their rate cuts haven't fully integrated into the marketplace. And that's part of the reason why they're on pause here, right? It takes a little bit of time for some of these rates to, when they do rate hikes or even cuts, to kind of filter through the economy and start to have an impact. And, anywhere from 6 to 12 months is what most economists say it takes. So the Fed on hold gives them a little bit of time for these to happen. And they still think that the unemployment rate, because of that, is going to still tick a little bit higher. But like I said, this last reading was 3.7%. Which kept us in line with the prior month. So, and then the number of new jobs. So what we are seeing is the number of new jobs created is a little bit lower than it has been. So last month we had 216,000 jobs added, which was still pretty strong and still more than the markets were expecting. The other area that we look at are the JOLTS. That's kind of the number of available jobs space that are out there, and it's still been pretty strong. It's in the $8 to $9 million range. It's not as high as it was. So all these indicators are still really strong, but they have come back off of their peak some, and they're starting to show a little bit signs of weakening, but not necessarily weakness. They're still very strong. There's still nothing out there on the employment side indicating that there's a mass, change coming in the employment situation right now. Even when you look at unemployment claims, they're still low by historical standards and still relatively steady. But those could be an early indicator of the unemployment claims that come out on Thursday of kind of, if you start to see those numbers start ticking up, then it could be an indicator that we are going to see a tighter employment situation. But certainly it's already starting to tightening up a little bit over where it was a year or so ago. So the jolts is one thing. We also have people that voluntarily quit their jobs. Those numbers have come down too. So employees are staying rather than looking. I mean, we still have people out there looking, right? But the numbers are coming down, the numbers that are willing to quit their jobs, because partly it's become a little more challenging to find a job, and partly because they can see some of the things that are going on in the economy, and some consumers are starting to get a little concerned and thinking, hey, maybe I'll stick with what's good and what I've been doing for a while. So still a strong job market, but keep an eye on the unemployment rate, initial jobless claims for signs of potential weakening ahead. And again, the Fed thinks we're still going to see a little bit higher numbers on the employment numbers, but still below really what historical numbers. So still pretty strong readings right now.
Okay. All right. So Tim, finally, it appears mortgage rates are starting to slowly recede, decreasing from 7.76% in October to now closer to 6.6%. How are the lower rates impacting the housing markets in terms of people buying homes, refinancing, or utilizing their built-up equity?
Yeah, so right, Jay. I mean, rates have certainly backed up a bit. As we talked, some expectations for rate cuts. Bond yields fell off. So I think anytime you get a drop like that, like you mentioned, about 1% or so, it brings some people into the market. Certainly some of those that they got mortgages at the higher, points. It'll be economically feasible to refinance. You see some refinance activity coming. We saw that applications for mortgages for new homes rose, but I expect it to be kind of noisy. I mean, as Scott indicated, the market's now digested that the March rate cut is likely not going to happen. So I think you'll see yields move around a bit here as we go through, the winter and the spring of the year, as different thoughts come out about what will eventually happen to rates and when. I think still though, the biggest impediment I think to the homes market is still just the supply of homes. Regardless of rate, folks can't find new homes to buy. People are staying in their homes longer because alternatives are so expensive. Still we're double where we were certainly when rates were good. So if you got in at the low point of the mortgage market, you're not looking to get rid of that low rate mortgage anytime soon, right? And we know there's a lot of investment companies, investment activity in homes that tended to suck up a lot of that supply in the market what was there. So I think it'll certainly be noisy, I think, for the housing market as rates move around a bit. But I think overall, there's still a lot of other factors weighing heavily on the housing market as well.
All right. Well, thank you both so much for the time. Scott, any final thoughts for our listeners today?
Yeah, I would just say, we're definitely at an inflection point here. We're at the end of the cycle, really. We've seen this for a while. Coming into the December meeting, the Fed was their bias was, they were on hold, but their bias was still towards raising rates. When we hit the December meeting, that changed. Still on hold, but their bias shifted from rates higher to more neutral or rates heading lower, rate cuts. So the odds are very strong that the next rate move is going to be a rate lower, cut. It's just a matter of the timing for that. So that's why what I would do is, and we mentioned this at almost every one of our calls, is just pay attention to what the members of the FOMC, the regional Fed presidents, what they're saying, because they've been pretty upfront and transparent, in my view, through this whole cycle. And they've done exactly what they said they were going to do. Nothing's been a surprise thus far. What's been surprising to me has been the market's view of everything. The Fed has been pretty clear. The markets, for some reason, have found the wording to be murky, at least based on their when you look at Fed fund futures and market rates, what the markets think the Fed is going to do. But if you actually listen to the Fed, it's been pretty obvious what they're going to do. So, pay attention to the economic data that we mentioned earlier, those key points, and really pay a lot of attention to what the Fed has to say. They're not going to, barring some crazy piece of something crazy going on around the globe, the Fed isn't going to do something that they haven't kind of telegraphed to the markets that they're going to do, and they're going to give us plenty of warning as they have throughout this whole cycle. So just pay attention.
Yeah, to what you guys have said every time, they've been very transparent. So anyway, well, thank you both so much for helping me kick off season 3 of our podcast, with me today. I appreciate you taking the time to share your insight with our listeners. This episode of Financial Minds Meet the Experts is brought to you by Vizo Financial's 2024 Financial Strategies Workshop. Some may think that credit union finance is just about crunching numbers or moving assets or a bunch of other tasks, but we all know better. Of course, it's about all those things, but it's also about playing the very intricate and interrelated tug of war involving interest rates, market trends, economic performance, and so many other contributing factors. And that game, above all else, requires good strategy to keep your credit union well positioned for success. Vizo Financial's 2024 Financial Strategies Workshops are back to give your credit unions those strategies to manage your financials and stay ahead of the game. Each one-day event will provide engaging and informative content brought to you by our very own financial experts to empower you with essential financial strategies that go beyond the basics. Find more information on our website at www.vfccu.org. Thanks so much for listening, and make it a great day.